Today, oil buyers are apparently resting from yesterday's active trading. After rising above $95 per barrel, oil prices fell below the 94 mark. At the same time, the situation in the energy market has not changed. Market participants remain concerned about a potential oil market supply shortfall in the fourth quarter. Against this background, the Russian government is considering imposing export duties on all types of oil products of $250 per metric ton from October 1 to June 2024 to address fuel shortages. Meanwhile, crude oil inventories in the United States continue to decline. The American Petroleum Institute reported a 5.25 million barrels draw in the U.S. crude stockpiles last week. Moreover, U.S. oil output from top shale-producing regions is set to fall for the third month in a row. According to the trading chart, buyers locked in profits as expected, with a target at around $96 per barrel. As a result, Brent crude pulled back by about 2.5%. At the same time, given its stunning gains in recent times, this decline can hardly be called a correction. Even for a local correction, oil prices need to dip to at least $90 per barrel. And today's meeting of the U.S. Central Bank may well kickstart a corrective move in the oil market. The Federal Reserve is widely expected to announce its intention to further raise interest rates, which will contribute to a continued rally in the dollar. And in this case, the inverse correlation between the greenback and other trading instruments will come into play. The outcome of the Fed's meeting is also of great importance to gold traders. The only difference is that the yellow metal is much more dependent on the monetary policy decisions taken by major central banks. And thus, further policy tightening, or at least statements about the further interest rate hikes, is likely to bring gold prices down. The metal may drop to $1,900 per 2 ounce in a fairly short period of time. In the meantime, gold is stabilizing above the level of $1,930, which is a positive signal for buyers. And the volume of long positions will increase further in case the price returns above the $1,930 mark. However, from a fundamental point of view, it's unlikely. As for a pure case scenario, market sentiment will shift if the price falls below the level of $1,920 per 2 ounce. Speaking of the ruble, although yesterday's macroeconomic calendar was bereft of any important news releases, market volatility surged. The dollar alternated between losses and gains in the range of 98 to 95 rubles. Such large intraday fluctuations usually indicate an upcoming shift to a new range, and the only question is where exactly the ruble will move. Given that all the previous efforts of the Bank of Russia and the Ministry of Finance to provide significant support to the Russian currency have failed, it will most likely keep losing value, heading toward the mark of 100 rubles per dollar. And that's all for now. We continue to follow developments in the financial markets. Subscribe to our channel and follow the news with us. And see you soon.